Good evening, everyone. Thanks for joining us today with our fourth quarter US strategy and stock picks. So with me today, we've got my fellow research analysts, Ambrish, Max, and Zane, and we'll be sharing a little bit more about what kind of happened in the third quarter of this year and what we expect to see in the fourth quarter coming up. So just an outline of this presentation, we'll cover the US market performance, some macro sector themes. We'll run through the FANG-Ams, as well as some new stock coverage that we initiated on in the third quarter of this year. And we'll finish off with the technical analysis before moving into Q&A. So the first question, how did the market perform in the third quarter of this year? Right here, I put a little fat bear with his tongue sticking out, just to reflect, how the markets have been this year, especially in the third quarter. Overall, we saw a really broad sell-off. The S&P, the Nasdaq, all down about 5-6%. Bonds were down 8%, and commodities as well down 5%. And most of these were actually just due to a really poor September month, where the S&P and the Nasdaq were down both 10 and 11%. Commodities continue to lose traction, but still remain the main winners for the year, up 15% year to date. In terms of the sector performance, surprisingly, consumer discretionary held up the best. They were the only positive sector for the third quarter. And real estate was the biggest laggard, down 13%, primarily due to rising mortgage rates. I believe they're at 15-year highs at 7%, as well as slowing home sales. For the year to date, growth continues to underperform. So you can see at the bottom, technology and communications are just really lagging, while defensive sectors like consumer staples and healthcare remain a little bit more resilient. One thing that's been quite interesting is that the US dollar has continued to strengthen versus most other currencies. It's also very interesting that they're kind of acting like almost like equities, in terms of the fluctuations in currency strengths. Particularly against the yen. The yen this year is down about 20% compared to the dollar. And a lot of this is mainly due to a lot of the quantitative tightening measures and hawkish Fed policy. And one of the reasons why the Fed's able to do this is because the US market is generally a bit stronger and can withstand a lot of higher interest rate hikes. Also, the strengthening of the US dollar has kind of affected a lot of big tech earnings, especially as about 50% of revenue from big tech comes from outside of the US. So the next question is, what are some of the macro themes that we're seeing? The first is there's extreme fear in the markets right now, or in the economy in general. US consumer sentiment remains pretty low. We did see a little bounce from the June lows, but it still remains at similar levels during the GFC, the Great Financial Crisis in 2008 and 2009. And it's mainly surrounding weakening consumer demand and as well as recession fears. The bond market is actually pricing a recession about 6 to 12 months from now. What we're seeing here is the yield curve, which is the spread between the 10-year treasuries and the 2-year treasuries. This yield curve has inverted quite significantly in the last few months, and usually it's quite a good indicator of a recession coming in 6 to 12 months from when the yield curve inverts. Something that's very interesting about this year is that usually during a recession is when markets start going down, but this year, before we've even reached a recession, markets are already down, 25-30%. I suspect some of this is mainly because investors or the markets right now have a lot more information to go about, so they're able to kind of price in recessions or a little bit sooner than before. And also, compared to a lot of the past recessions, we were kind of right now we do think that if there is a recession, we may not see the same kind of movement that we used to see in the past, mainly because a lot of it has been priced in already. On a more positive note, unemployment in the US remains relatively low at 3.7%. Generally, unemployment below 5%, 4 to 5% is pretty good. Wages have also been increasing about 5 to 6% year on year. And this could be one of the largest reasons as to why the US hasn't really declared themselves in a recession as of yet. But you can see in the past, once unemployment starts rising and going past the 4 or 5% mark, that's usually when a recession hits in. So it's worth noting and worth looking out for. The second theme we're seeing is don't fight the Fed. As everyone knows, inflation has been pretty high. This chart is the US core PCE versus the Fed funds rate. So you can see core PCE or core inflation right now is about 4.9%. And the Fed funds rate is hovering around 3%. One reason why you use the PCE instead of CPI is because of its wider coverage. It's also taken from suppliers instead of households, and it also includes non-urban households and non-profits. Core PCE strips out more volatile sectors like energy and food. So you can see right here the core PCE average is about 1.8%, and the Fed's target for inflation is thereabouts at 2%. So we're most likely going to see the rates continuing to rise at least until core PCE starts coming down to that 2% level. And just by the way, core PCE is also what the Fed uses to gauge inflation. So this is a chart of the expected rate hikes. So it's widely expected that rates are going to peak in around March of 2023. Right now we're in the 3% range, so we expect another 125 to 150 basis points hikes in the next two Fed meetings in November and December. We do expect interest rates to peak at around 4.5 to 4.75% before remaining relatively flat and maybe declining a little bit for the rest of 2023. This is just a chart of the personal savings rate in the US. Right now you can see it's at 3.5%, so relatively low compared to its average of 6.6%. So this is a 40-year average. You can see there's a really big spike in the first quarter of 2020. This is mainly due to stimulus checks in the US. People are not really able to spend during COVID. But ever since that has kind of ended, higher inflation has caused people to spend a little bit more of their income, resulting in a lower personal savings rate. What we're actually seeing right now in terms of inflation is that supply chain issues seem to be easing a little bit. This is the Baltic freight index. So it just measures average weekly shipping prices of 40-foot containers. You can see, since the beginning of this year, it's been kind of falling quite a bit, and this is somewhat of a deflationary movement moving forward. So we do expect these rates to kind of come back down significantly, at least back to its pre-COVID, pre-pandemic levels. Sorry. What we're also seeing is that there's kind of an overstock in inventories, leading to more discounts in terms of retailers. So this is a retailer inventory to sales ratio. You can see pre-COVID, the inventories were at about 1.4 times its sales, and then during COVID it dropped to 1.2, and right now it's at 1.6. So we're seeing a lot of warehouses full of merchandise, full of goods that people aren't really buying, and a lot of retailers just kind of have to or have been selling a lot of them at discounts, leading to kind of contracting margins for them because we have to sell it way cheaper. This is also another deflationary measure, which I guess is kind of a good thing in the long run, at least in fighting inflation. So our third kind of theme is that we're seeing corporate earnings growth remaining a concern. So earnings growth is expected to slow down. This is a chart of the Nasdaq forward PE. So right now it's about 20 to 21%, and the main reasons for this is mainly due to contracting margins, high interest rates, as well as FX headwinds with the strengthening dollar. So we still do see a little bit more downside for the Nasdaq. We see about 8 to 10% decline, especially as valuations start coming down to more reasonable, I guess, pre-COVID levels in the range of 70 to 20. So our third question is, what kind of trends are we looking out for right now? And the first would be retail sales. So there's a chart of retail durable goods, so your furniture, your home electronics, stuff like that. So we think that what we're seeing right now is that retail sales remain stagnant, but still above pre-pandemic levels. You saw this big dip during COVID, and then a real surge towards the hello, sorry. Yeah, so we're seeing this. Sorry, what was I? Oh yeah, so right now retail sales are kind of have been pretty stagnant, and one of the reasons is because prices of a lot of goods have actually increased, and people are a little bit more worried about about a recession coming. They're kind of tightening their budgets, their belts a little bit. On the other hand, we expect tourism to continue its recovery. So this is just a chart of travel spending and arrivals in the US. So travel has actually had a really slow rebound, but it's actually starting to pick up. In the midst of the pandemic, spending was down about 80%, but right now it's only off by about 30% of its pre-pandemic peak. So travel arrivals have also started to pick up quite a bit, but it's still slightly more than 50% lower than pre-pandemic levels. We do expect this trend to continue, especially during the holiday season coming up, which should definitely help companies like Booking.com and Airbnb. So our last kind of trend that we're looking out for is streaming. Currently, we're seeing streaming surpassing cable, which is kind of the long-standing leader in TV entertainment. You can see, in July, streaming had about 35% market share, and it surpassed cable for the first time ever. And definitely has a lot more room to grow, just based on how available it is and how much cheaper it is for consumers. You're paying like $15, $20 a month compared to the cable, which can cost anywhere from $50 to $100. And this should, and we do think that streaming, just based on its flexibility and availability, will continue to increase. And also, the kind of content you get a wider variety of content on streaming platforms as you do just on your broadcast cable. And this is something there'll definitely be tailwinds for the streaming industry moving forward. So now we'll move on into our recommendation of big tech. We'll just cover all the FANG-M companies. For the FANG-Ms right now, their forward PE is around 30 times, which is slightly below their average of 31 times, but it's definitely quite a bit more above pre-pandemic lows, or rather pandemic lows. So we think right now, it's quite fair value, but we think growth may be challenged a little bit, mainly due to higher interest rates, and a lot of kind of pullback in consumer spending. So for our first counter on Meta platforms, we think that Meta continues to be underappreciated. There is a little bit of near-term uncertainty due to the overall slowdown in digital advertising, especially amidst a weaker macro environment. So slowing revenue, as well as contracting margins that because they're spending a little bit more on shifting their platform towards a more video-centric, short-form video-centric platform. It's really not a good recipe for any company. But we do, so we do think that this is going to be obviously a near-term issue, but definitely something that the company can overcome in the future. It's currently trading at historical low levels, like about 11 times forward PE, so well below its average of 32 times. and well below the Nasdaq's average of 21 times. Obviously, on the positives, again, they do have a strong network effect. They have so many monthly active users, which can be kind of a headwind for them because they've already kind of gotten a significant amount of the overall global population, because you have to take out China's population, and so it's definitely going to be incrementally more difficult for them to grow their users. Moving on to our next company, Netflix. So for Netflix, we think that they continue to have strong pricing power. In this chart, it's just the monthly average revenue per membership. So it's basically your pricing. You can see that quarter on quarter, they've kind of been the general trend is that it's been increasing over time, which is definitely is a positive, showing that they've got relatively strong pricing power. They've been able to increase prices and add users at the same time. They're also still the market leader in streaming. Their prices, their ARM, average revenue per member, is at least twice that of Disney Plus, which is their closest kind of competitor. They also have about 4 times more viewership hours than Disney Plus. Netflix is also starting a new ad-supported subscription tier that should boost their margins moving forward, because ad margins are basically the highest margin kind of revenue you can get. We do think that this definitely would be a positive for Netflix, especially as it targets a lot of users that don't mind paying less to have ads in their streaming experience, while still being able to experience the wide variety of content that the platform has. The company is trading at about 22 times forward PE, so it's about the average of the Nasdaq's 21 times forward PE. Netflix does have a slight problem with user growth, especially in developed regions, especially as people like to share passwords. It kind of has been a major problem for Netflix, and they are trying to solve this issue by introducing pricing plans that users can currently purchase for additional users that are not within their same household. Moving on to our next counter, Alphabet. So we think that Alphabet's or Google's growth remains resilient. The main reasons for this is obviously their monopoly in many industries, like your digital maps, your internet search, and the digital advertising industry, where they have more than 50% market share. In terms of revenue, their second quarter revenue grew about 13% year on year, despite a 3% for FX headwind. Cloud, remains the company's fastest growing segment, with growth of about 36% year on year. In terms of valuations, we think that they also remain fairly attractive right now at about 16, 17 times for PE, which is more than one standard deviation below its average of 22 times. We do think that for the rest of this year, they also will be, and they have been affected a little bit by the slowdown in the overall digital advertising industry. But we still forecast the company to grow at about 16 to 17% year on year for FY22, and about 20 and the low 20s for FY23. So with that, I'll pass my time on to Max to cover the next few counters. Thanks.
Thanks, Jonathan. Good evening, everyone. I'll start off with Apple. So the first point for Apple is that its higher margin services segment is continuing its year-on-year growth, and this is beneficial for Apple because the services business segment actually has a gross margin of around 70%, compared to the hardware product segment, which has a gross margin of around 30%. So this means that the services segment is actually more profitable than its hardware products. As we can see from the charts on the left, the numbers are computed by taking the trailing 12 months of total services revenue earned and divided by the total number of iPhones shipped during the same period. And we can see that the numbers are generally on that upward trend, suggesting that the services segment is continuing its penetration, and at the same time, users seems to be spending more on services provided by Apple. However, we would like to point out that this number doesn't necessarily mean that a person would spend around $200 to $300 on top on services after they purchase their iPhones. These numbers are just to act as a proxy. And secondly, is that we are also expecting a higher average selling price for Apple, and this is because for iPhone, this is because Apple decided to discontinue its iPhone mini model, which is the lower price model. And recent reports have also been indicating that the iPhone 14 Pro and the 14 Pro Max are selling much better than that of the base iPhone 14s. So we believe that these two factors will definitely jack up the average selling price of its iPhones, and it will ultimately contribute to the revenue growth of Apple moving forward. However, lastly, the Apple recently decided to cut back on its decision to increase the production capacity of its iPhone 14 model, and we feel that this is not surprising given the current weak consumer discretionary spending because of all the high inflation as well as the rising recessionary fears. So we believe that this will affect Apple sales in the short term in the short to medium term until the inflation has started to taper off. So with that, we have all in all, we maintain our buy rating at a target price of $198. Yeah, moving on to Amazon. Amazon is still a beneficiary of the continued migration to the cloud done by companies, as its AWS segment continues its year-on-year and sorry, as it's sorry for that. Amazon is still the beneficiary of the continued migration to the cloud done by companies, as its AWS is still experiencing its year-on-year and quarter-on-quarter revenue growth. And this is also beneficial for Amazon because its AWS has an operating margin of around 30%, which is much higher than its retail business, which only has around 2 to 3% of operating margin. And secondly, we are also expecting a strong second half of this year for Amazon. And this is mainly because of the two primary events that took place during this time. So Amazon held its annual primary event in July, which falls under the third quarter timeline. And recently, it also holds a second Prime Day-like event a few days ago, which took place in 15 countries, but unfortunately, Singapore was not one of them. So we feel that these two events can act as an avenue for Amazon to boost its revenue performance, but at the same time to clear its current high levels of inventory. And yeah, moving on to the last point, Amazon's retail business segment is experiencing a shrinking margins, and this is mainly because of the inefficiency due to the rapid expansion that the company did during the COVID times. And furthermore, it is in line with the other and the general retail industry. Amazon is also facing an increasing levels of inventory, and this is also because of the shifting consumer purchase preferences as well as the decrease in discretionary spending. So all in all, we maintain our neutral rating on Amazon with a target price of $133. With that, I'll hand over my time to Ambrish. Thank you.
Thank you, Max. Thank you. So good evening, everyone. I will be covering Microsoft. So the title for Microsoft is both volume and average revenue per user are rising. For Microsoft, the two main growth drivers are Cloud Azure, as well as its productivity software, Office 365. So the number of users for both these segments and the pricing is up. So moving on to the positives, Azure is Microsoft's cloud computing service. So basically, cloud means you can store and access the data over the internet. You don't need to store those data on your local personal computer. And you can even access it via a remote access. The main advantages could be it is mainly because it is efficient and it is cost effective. So Azure, it is the Microsoft cloud computing service, and it is the second largest cloud provider with a market share of about 20%. The Microsoft, it doubled its Azure share from 10% to 20% in last 3 to 4 years. And the largest cloud player is Amazon Web Services, AWS, which has a market share of about 33%. We believe that Microsoft, it would continue to gain share mainly because it is has an integration capability with its Microsoft Office, as well as the company claims that it is 5 times cheaper as compared to Amazon. And also, as the companies that digitize their operations due to the digital transformation trends, we believe that Azure will continue to gain the public cloud market share. So secondly, there is a robust demand for Office 365 productivity software. This is mainly because Microsoft, it has a 90% market share in the overall productivity software market. And the key growth drivers for this segment, they are mainly because as the offices reopen and the economic reopening, as the companies, they hire new employees, there would be a surge in demand for its productivity tools, mainly due to the ease in work and task management flows. So more number of people are expected to use Office 365. And lastly, in terms of negatives, we believe that there is a slowing demand for the PC sales, and this could hurt the Microsoft's Windows revenue. And the slowdown, it was mainly because of weak demand, as well as a chip shortage and supply chain issues. So overall, we remain positive on Microsoft, and we have a target price of $332. This is mainly because for Microsoft, there is an earnings visibility, as it is mainly focused on corporate spending and not on consumer spending, which is one time. So corporate, they need to spend more in order to be competitive. So we have expanded our coverage in 3Q 2022, and we have initiated our coverage on PayPal, Property Guru, and Spotify. I will be covering PayPal. So our title of the report was Two-Sided Network Effect Getting Stronger. PayPal, it is basically a digital payments company. It has a global presence in almost about 200 countries and regions. And it has a large customer base. It has about 400 million customers, as well as about 35 million of merchants. So it enables customers to transfer money from one person to another person, a family and friends who already have an account on PayPal. And it all, as well as to pay for any product or services they had purchased online. And secondly, it enables merchants to receive for any items that they have sold. So the PayPal, it mainly generates its revenues, like about 90% of its revenues are generated from transaction revenues. These are mainly the fees that it charges to the customers and its merchants. This is calculated as a percentage of the total payment volume that have been successfully completed on its platform. Moving to our thesis, it's a two-sided network. It is a competitive advantage, mainly because PayPal, it added almost about 200 million customer accounts in last 4 years. So this is mainly because of its two-sided network platform. So like it has the information of both ends of the transaction for customers' information and the merchants. So what the PayPal does is that it leverages the customer account information, and it provides customized offers and discounts from the merchants to customers. So also additionally, its total payments volume, it increased from about 600 billion to about almost 1 trillion in FY21. And this was mainly because in the growth in number of users, as well as the number of surge in payments volume. So we believe that this particular payments volume and revenue, it would be growing by double digits, mainly because of this strong network effect, as well as due to surge in online shopping, and also because of digital payments trend. So moving on to our second thesis, it helps to boost checkout conversion rates and sales for merchants. This is mainly because customers, they are they are more likely to complete a purchase transaction if there is a core PayPal checkout at the payment page instead of the credit cards. This is mainly because of a better experience, like there are less number of clicks, as well as there is the credentials are already stored and you don't need to mention your credit card details. So this value proposition, the company claims that its conversion rates are like 80 to 90%, significantly higher than the industry average. And because of this, PayPal, it has almost partnerships with about like top 1,500 retailers, 75% of top 1,500 retailers in North America and Europe. It includes Shopify, Booking.com, as well as Walmart. So PayPal, it also provides merchant loans for their working capital needs. So it basically helps them to grow their sales, which I mean indirectly would benefit PayPal. So because the payment volume would increase on their platform. So additionally, even its peer-to-peer mobile payment transfer service, which is Venmo, it is being expected to launch as a payment service on Amazon platform. So it is likely that once it is accepted as a payment option, it would grow its top line because of the surge in online shopping. In terms of negatives, we think that if any deterioration in a macroeconomic environment, or if inflation, or if there is a surge in unemployment rates, then it could lower consumer spending, and which in turn would lower the payments volume. And basically it would hurt PayPal's revenue as well as its profitability. And also there is like in case if there is a recession, then PayPal, it provides loans as well. So maybe there could be a high number of defaults. So overall, we have a buy recommendation and a target price of $116 US. I would now like to pass on to Max for Property Guru.
Thanks, Ambrish. So recently, we also initiated our coverage on Property Guru, and with the report titled Dominant Property Platform. So Property Guru is a company operating an online property listing marketplace, property marketplace where home buyers can use to look for houses available to buy, as well as property agents to post their listings of property available for sale. So the first investment merits for Property Guru is that it has a dominant market presence with 76, 96, and 75% market share in Singapore, Malaysia, and Vietnam, respectively. And its revenue has experienced a 4-year compounded annual growth rate of 22% from FY17 to FY21. We expect this to further grow, even further at a 2-year CAGR of 37% through FY23. And this is mainly because of the increased adoption of its more premium subscription tiers. Furthermore, Property Guru's dominance in the market can also act as a barrier to entry for new entrants attempting to compete for market share. And this is because of the strong network effect resulting from the increased penetration onto its platform. So this means that as more users refer to Property Guru to view for houses, the more incentivized agents are to subscribe to its services in order to allow them to post on the platform. The flip side is also true, whereby as more agents post their listings onto Property Guru, the more likely home buyers refer to Property Guru because they have more options all in one place. So this continuous cycle will continue to go on, and ultimately resulting in the increased amount of platform users. Moving on to the second investment merit is that Property Guru possesses a strong pricing power with a high renewal rate. So Property Guru earns revenue by charging subscription fees to property agents who wish to use its services. And it offers several pricing tiers depending on the benefits that the agents require. So its Property Guru's most basic subscription tiers actually cost 43% more than that of its biggest competitor, but it still manages to achieve around 82% of renewal rate in the first half of 2022. So this signals that Property Guru is able to command premium pricing, and at the same time, it may grow its revenue by incrementally increasing its product prices moving forward. And And this is especially true as agents are likely to face high cost of switching when home buyers are getting accustomed to using Property Guru platform. However, Property Guru has limited penetration in Thailand and Indonesia. So the company has operated in both countries since 2011, but both markets only combine for around 8% of the total revenue of FY21. So specifically for Indonesia, which represents around 40% of the total population in the Southeast Asia and the largest market opportunity, we feel that the marginal revenue contribution signals that Property Guru has limited ability to capture and grow its market share there. And all in all, we initiate our coverage on Property Guru with a buy recommendation at a target price of $5.73. With that, I'll hand off my time back to John. Thank you.
Yeah, thanks, Max. So I'll be covering Spotify. They are the leading global audio platform. What we like about it is that they are the dominant audio streaming platform with 31% market share. At the same time, volume and prices are both growing, so they're increasing their users and they're also raising prices at the same time. Users have been increasing by slightly over 3 times in the last 5 years, which is quite incredible. And that's definitely something that you want to look for in a company. We also like its recurring revenue business model, which has a relatively low churn, and churn has been improving year on year. One thing about recurring revenue is that it's generally quite sticky. For a lot of users, you just put it on your credit card every month and you just forget about it. So in the sense, you always the company always has this base of revenue that it derives from its premium users. And so we think that stability with revenue growth is definitely something that is a positive for the company. If you look at this chart on the left, it's basically your premium subscriber revenue versus ARPU, which is prices. You can see that premium subscriber revenue, which is about almost 90% of total revenue, has just been growing year on year. I believe it at a 26% compound annual growth rate. So if you do the math, it's like they're doubling their revenue every 3 years, which is a really fast pace. In terms of ARPU, which is the subscription prices, they were kind of going down quarter on quarter for each quarter for the last few years up until the first quarter of 2021. Several reasons for this. First is that they were expanding into areas that were not as easy to monetize, so regions like South America and Asia Pacific. And secondly, they were actually instead of just having one single user plan, they expanded into multiple plans, and usually with multiple user plans, it kind of brings down the ARPU because instead of $10 per user, now you're charging like $13 for 2 users, so the average user is now paying only $6-7. But we do also think that they're going to definitely benefit from tailwinds in the audio streaming industry. They're seeing an increase in adoption globally, particularly in Asia Pacific, where users have been growing about 40% year on year. Also, there's a very strong use case for Spotify, especially as it takes on traditional radio and satellite radio like Sirius XM. Especially in your car. So a lot of people right now, instead of listening to just your typical radio stations or plugging into your phone, a lot of cars right now, they already have the Spotify app in them. And all you have to do is just log into your account and stream whatever music you want on the go, and that's something that is definitely a positive and a competitive edge for Spotify. One of the negatives and the most important negative that we see is that they're heavily reliant on third-party licensing agreements, which are renewed every year. So this is really the bulk of their cost of sales, and one of the reasons why their margins are relatively low. So they've got to pay off, or they've got to enter into agreements with like record labels and artists and producers and stuff like that. because every time a user plays or a song plays, a percentage, or rather maybe like 1 cent or 2 cents gets paid to the record label, and if you times this by billions, then it's definitely a lot of money. Something that they're trying to do to mitigate this is that they are actually or they've been moving into the podcast and audiobooks kind of space. And one of the reasons for this is because these are usually longer audio formats, and a bit more available and attractive to advertising placements. So they're trying to get a little bit more advertising revenue on that, because for right now most of it it's just recurring subscriptions, right? But they have about 10 to 12% of revenue that comes from advertising, and they're trying to grow this advertising faster, especially because they are high margin revenue, and it will definitely help to grow their bottom line and all their margins in general. So it's something that right now Spotify is not profitable, but they are very close. I believe they lost about 30 million euros last year, and for this year we expect them to be roughly in the same 20 to 30 million euro in terms of a net loss. One of the main reasons is because they've invested heavily in their platform, and they will continue to invest to build out their platform moving forward. We do have a buy rating on it with a target price of $117. Right now, we currently cover about 14 companies. So this is just an overview of the companies that we have and what their target prices are. So with that, I will pass my time now on to Zane to do the technical analysis. Thank you.
Thanks, John. So now I'll do technical analysis of the US indices. So first, I'll begin with an outlook of the S&P 500. The S&P 500 has been obvious downtrend this year. So when we look at the charts, currently we're in this descending broadening wedge pattern, and then we are currently in a wave down inside this descending wedge. So start of this year we had a wave down, and then until March we had a rebound wave upwards. Then towards June we had the wave down again. Then we had a relief rally upwards into August, and currently we are now back into a wave down pattern. In a wave down. So when we look at using Fibonacci retracements levels, when we look at the March lows in 2020, that's about 2,191, and then the all-time highs was about 4,818. And currently we are sitting near the 50% Fibonacci level, so that's about 3,500. So with that, I think in the fourth quarter there's a chance that we might tag to the 61.8% level. That's about near 3,002. That the technical level is 3,195, and it also coincides with the support of this broadening wedge over here. So in the fourth quarter, there's a chance that we might tag to about the support area of 3,002 to 3,000 points area, which is this green zone over here. Moving on, I'll talk about the chart of the Nasdaq. So for the Nasdaq, currently we are in this downtrend channel within a downtrend channel itself. So in the larger picture, we're in this big downtrend channel over here, and for the currently we're in this smaller downtrend channel. So recently, with the similarly to the S&P, we also have a few waves ups and wave downs this year. So currently we are also in a wave down. And recently we saw resistance over at this resistance zone about 12,000 to 13,000 points, which is confirms of this resistance of the downtrend channel over here, as well as the previous support over here back in the early part of this year, which turned resistance over here. So for the fourth quarter of this year, I think we might see the Nasdaq come to this green support area, which is the 61.8% level. That's about 10,300 points area when you measure from using Fibonacci from the lows of March 2020 to the all-time highs back late last year. if we go deeper than 61.8%, we might actually come to near maybe 9,400. So this level will be the pre-pandemic highs of the Nasdaq, which was a previous resistance back over here. And then after back in 2020, when the market started to recover, it was a support level here also. And then it also is near this downtrend channel support over here as well. So there's a chance that we could hit between 9,400 and 10,300 if the market continues to move in this downtrend. But that being said, technically why from a technical point of view, slightly that we continue in this downtrend, but US indices tends to perform well in the last quarter of the year. So we still have to see how it goes. So with that, I'll hand back my time to John. We'll talk about the conclusion.
Yeah, thanks, Zane, for that. Okay, so in conclusion, we do expect inflation to have peaked, but we do also expect it to remain elevated, at least for the next 3 to 6 months, before it really starts coming back down to the levels that the Fed wants it to. Definitely, in terms of putting money in the market or trying to guess where the markets are gonna go, we think that waiting until the Fed pivots, until it becomes a little bit more hawkish, less hawkish and more dovish, I think that will probably be the signal to where there'll be a little bit more greener pastures moving forward. For right now, there's a lot of uncertainty, a lot of volatility in the markets. Everyone's watching CPI numbers which just came out. And the markets react quite violently to a lot of these readings nowadays. Whereas before COVID, no one really was paying attention or too much attention to it. The third point that we want to make is that we want to look towards earnings growth to kind of boost or to kind of give you the direction in terms of how the markets are going to be doing. I think a lot of investors have kind of been spooked in the last year or so. They're really going to be focusing a little bit more on earnings growth, paying a premium for in terms of valuations for a lot of companies. Probably, we don't think that a lot of investors are going to be paying that much premium anymore. So definitely look to earnings growth to give you some sort of direction. So that comes to the end of our slides presentation. We'll move into the Q&A. But before that, please do feel free to join our community groups in our Poems Mobile 3 app if you haven't already done so. I'll just leave this page on for a short while. We do have several groups focusing on not just the US but also Singapore markets as well, and not just equities but fixed income and ETFs as well. Yeah, so with that, I think we'll start taking some Q&A. I'll leave it at this page for now. We'll start with the most upvoted question. So our first question here is, among the 5 big tech companies which you have assigned a buy rating, which one is your top pick and why? So I think for the top pick that we have right now would be Alphabet or Google. Their valuations are pretty attractive. Revenue generation is still very strong, and they are pretty much a dominant player in a lot of categories. When it just comes to Google search, right? People always just say, I'm going to Google this, I'm going to Google that. Nobody says I'm going to Bing this or Yahoo this anymore. And we think that is definitely a really strong point, especially when it relies so heavily on digital advertising dollars. On the flip side, it does also have a very strong cloud business that is growing really well. It has, I believe, it has about $50 to $60 billion in a back order, which should last them for quite a while. And obviously the orders are just going to keep growing and growing as people kind of transition their just mainly due to, I guess, digitalization, people kind of going into the cloud and all that. So Google will definitely be our top pick. I'll take a few more before I pass it on to the rest of my colleagues. How long is your time horizon for target prices? Usually they are, not usually, but always, they are always 12 months in advance. We have another question here, Fang M. In view of slowing growth, global issues, etc., Fang M over the years, prices have gone up too significantly. Warrants overall recalibration. Share your opinion. Yeah, definitely, especially over the last couple of years during COVID. I guess a lot of stimulus checks, a lot of people starting to trade a little bit more. You can definitely see your valuations for a lot of these companies just skyrocket. And in the last 9 months or so, as the markets have begun to sell off a little bit, I think people have become a little bit more prudent. They're no longer, you look at something that's like 30, 35 times forward earnings. People start to question nowadays because they don't expect growth to be that significant. In our opinion, a lot of the FANGs have actually have been already devalued. They've dropped quite a lot. Aside from Amazon, where its PE is still relatively high, most of the other companies, when you compare it to their average PE for the last 10 years, average forward PE, they're way below. They're either below average or below one standard deviation from its mean. So we do think that most of the FANGs right now are fairly attractive, just based on valuations. The next question would be, would you think the markets would remain depressed so long as the war in Ukraine drags on? And also if the trade war between the US and China persists. So when it comes to the war in Ukraine, we don't think it really has that much effect on the markets. Obviously, it does have some effect in terms of inflation. It contributes a little bit to high prices, especially grain and so on. But the main issue that we see in the markets right now and why it's in the state that it's in is because growth is GDP is negative, has been negative for the last couple of quarters. And inflation, because of the significant QE from the Fed, has really caused a lot of things to become more expensive. Definitely, it's like once you turn off the tap of cash to your investors or whoever, they really don't have a lot of income to spend on goods, on a lot of other things. So we think that inflation is more of the problem than the war in Ukraine. And the Fed can only do so much. They can only kind of handle. They can only really dampen the demand side to a certain degree. Like you can't really start raising rates too much too quickly. So I think a lot of the supply side issues that the Fed can't really deal with will just have to it just kind of takes time to subside a little bit, and hopefully in the next maybe 9 months to a year, things will be a little bit different. So the next question is, are we in a recession? So technically, the US hasn't declared a recession yet, even though it's had 2 quarters of negative GDP growth. And we do think the main reason is because unemployment is relatively low at 3.7%. So you combine that, most of the population is employed, with wages, per hourly wages increasing quite significantly year on year. And so definitely consumers are in a little bit better position because they have a little bit more money, they are gainfully employed. The financial health of the market is also a little bit better as compared to the GFC. Banks are doing a lot better, even though right now there's been a significant sell-off because of the recession fears, because of defaults rising. Your credit default swap premiums have gone through the roof for a couple of the European banks, and people are just afraid that something similar to 08 would happen. So definitely, technically we're not really in a recession, but it kind of feels like it from a lot of aspects. Yeah. I think I'll take one more question before I pass my time on to my colleagues. When talking about Fed pivoting, what does pivot mean? So basically, instead of being so hawkish, instead of saying, we're just going to keep raising rates, when they pivot to become a bit more dovish, they'll be, okay, we're gonna stop raising rates. We're gonna. I don't think they'll go so far as to start printing money again, like to 2020 and 2021. But once the market starts hearing the Fed starts getting a little bit less hawkish and more optimistic, that's usually, and that'll probably be the cue for a lot of the money to start pouring back in. Especially as right now, the dollar index has gone through the roof. People are just holding a lot of cash. The cash eventually will get deployed somewhere at some point in time. Yeah. So I think with that, I'll pass my time on to my colleagues to try and answer some of the other questions. Thank you.
So there was one question about China has Microsoft-alike software. How is it invading into Microsoft's vis-a-vis growth? I will try my best to answer this question. I believe that there should not be much significant impact on Microsoft, mainly because it has already a dominant position. It has 90% market share in the productivity software market, as well as also more than 80% of the personal computers, they have a Windows operating system installed. And the Azure cloud revenue is also almost growing by about over 40%. So I believe that it has a good, good outlook. Earnings outlook is good for Microsoft. I would now like to pass on to the rest of my colleagues.
Yeah. Thanks, Ambrish. So there are two questions on semicon, but they are both on the semicon industry. So the question is your take on semicon industry, Intel, AMD, NVIDIA, and the impact of PC slowdown and sanction on China. We don't cover the semicon industry, but I'll try my best to answer this question. So yeah, definitely the semicon industry will be negatively impacted by the decline in the PC market, as well as the recent export ban of chips to China by the US government. So in fact, the Applied Materials have actually cut its current quarter's earnings forecast for its guidance, citing specifically for that export ban. And some research also say that they expect the semicon industry to decline by around 2 to 3% in FY23, in 2023 actually. Yeah, but for the silver, but there's also a silver lining in the semicon industry in general, which is that the demand for the chips used in data centers as well as in electric cars, which is a huge thing now, is still strong. So the revenues from the chips supplied to those two markets, which is expected to continue its growth and remain resilient. So we think that although the negative impact on the semicon industry is felt, it will be cushioned by those positive sides of the demand as well. Yeah, hope that answers your question.
Thanks, Max. So I think I'll take a few more questions before we hand it over to Zane for some TA. Right here, fourth quarter outlook, no mention of banking, big caps, non-tech. Yeah, sorry. So this fourth quarter outlook is actually it's supposed to focus on more of the tech companies. especially because our coverage is predominantly in the tech industry. We do try to throw in some insights from the other sectors, but just mainly because we don't cover it, it's a little bit difficult to talk about it. I'm sorry for that, but I think as we expand our team, we'll definitely look into covering different parts of the US market. Over here, what's your view outlook on Grab and C? So for Grab and C, they're both more profitable, which as of today and have gotten killed in the market so far. For Grab, it's kind of an uphill challenge because they still seem to be burning cash. It's almost like the more revenue they earn, the more loss they make. So until you start seeing signs where that doesn't happen, when margins start to get a little bit better, then it definitely will be a plus for them. But they're also operating in an industry that's very difficult. In terms of like transportation delivery, your take the main way they earn money is from take rate, and there's only so much you can take in these kind of industries. For C, there's a lot of noise about them laying off, and that's something that they've been I guess their own way of reducing costs to become profitable. They're a little bit closer to profitability, especially for Shopee. So we do expect them to be profitable definitely sooner than Grab. They are Shopee, which is their e-commerce business, is the leader in many markets in Southeast Asia and Taiwan. And they have also expanded and are doing pretty well in Brazil, in addition. So we do think that for C, we want to see them actually start making money in their e-commerce business before we can see any meaningful change or meaningful investment merits for the company. Yeah, I'll take this last question on Netflix. Despite the merit of Netflix from the inside, how do you see Netflix's external competitive strength and competitive advantages? Yeah, so when it comes to Netflix, or rather their competitors, there's always a lot of noise. A lot of them have been acquired, and there are a lot of by major entertainment companies. But the thing about Netflix is that they are also a lot of their shows, their original productions have won a lot of Emmy awards and basically a lot of awards, just kind of demonstrating the quality of its content. At the same time, viewership hours have continued to increase at a faster rate to their competitors. And they also have the most number of subscribers. So we've got about 220 million subscribers. If you compare it to Disney Plus, it's like 140 or something like that. But they're also able to effectively monetize their subscribers way more than their competitors. And I think that's one of their main strengths. That people are actually willing to pay high prices for their content, and that's something that we expect them to have for quite a while, especially because of the kind of content that they churn out week in, week out. Yeah, so with that, I'll pass my time on to Zane for some short TA. Thank you.
Hi, thanks everyone for your questions. Okay, I'll go through some TA for now. Okay, I see a very interest in big tech counters. So the first one I see is Microsoft. For Microsoft, currently we're in this downtrend channel over here. Recently we broke below double bottom at support at 240, and currently we're about around 220. When we use the Fibonacci levels from the March 2020 lows to the all-time highs, currently I think where the next immediate support could be at the 61.8% level. That's about 213 level. So last time in 2020 and 2021 over here, we can see around the 210 level is a key level for Microsoft. Yeah, so that could be the that could be a level of support, which also coincides with this trend channel support over here. Next one is NVIDIA. So NVIDIA similarly also in a downtrend channel for now. You see, sorry, we need to see whether I think this swing low, the key swing low 116, 117 over here is being taken out. So I think the next level we should look at based on the Fibonacci retracement is this 78.6% retracement. That's about 109. So that's the next level over here, the swing low back then, August 2020 to look out for NVIDIA. Then for Cvs Health, currently this one we're in a very well-defined horizontal support and resistance levels over here. So the support level is about 87 over here, but in the case that we do breach this level, I think the next key support to look at is near the $80 level over here, where we had a couple of swing lows form in July to October last year. If we do get lower than that, I think next level we should look at is about 72. That's a 61.8% retracement level, and also a previous horizontal resistance over here as well. Okay, I see. Next one is Google. So Google, recently the thing was that we broke down this bear flag pattern over here, and then we've reached our first support zone level back then when we filled the gap over here about $95, $96. But looks like we might be heading down lower. So the next level might be about $89, $90, 61.8% retracement level. So that was also back then a horizontal resistance over here in November 2020 to January 2021 over here. Okay, then for Amazon is relatively weaker compared to other big tech. So recently the development was that it broke down this uptrend support line over here, and then I think there's a chance that we might retest about 104 this level, 104, 105, 78.6% retracement level, and it also coincides with a bunch of swing lows made in May to June this year. So it's very possible that we could see a retest of these levels for Amazon. And then for as for Meta, it's also very weak. This one is in the weekly chart. So from the weekly chart, we can see that this key trend support line was being broken. And then so that signals for some downside to come. So the next level of support is about 123. So I think we are there about it. We are about there during the pre-market. So in the case we do get lower, then I think the next swing low to look at about is 115 about this level, which is a key level back then as far back as 2016. And for Salesforce, I think for Salesforce wise, we are quite near back to the quite near to the March lows level already. So I think the key support zone for Salesforce is over here near the 130, close to 138 to about 148, the $10 zone over here. So if this zone does get breached, I think very likely we do test back. We do get a retest of the March 2020 lows near the 115, 116 level, which is another key horizontal level to watch out for. Yes. Okay, see the last question is on Visa. For Visa, sorry, I think it's the wrong counter. So for Visa, it's also bearish. Importantly, this key support zone over here, 185 to about 193, it was being breached, and then we did a retest where it became a resistance when we saw another downward movement in the stock. So with that, I think slightly possible that we could reach the next horizontal level about 172 over here. Okay, I think let me start Fibo 2. So yeah, 177. Next one is about 172 as mentioned. If you do get low, maybe you will see 157. That's 70.6% retracement. Yeah. So that's for me for the TA portion. I'll hand back the time to the rest of my colleagues.
Yeah, thanks, Ian. So actually, I think we've kind of come to the end of our presentation. Just want to thank you guys for watching. I'll hand it back over to Roshan to wrap it up for us. Thanks. Oh, sorry. Also, if you have any more questions, please feel free to send it over to our email. We'll try to respond accordingly and get back to you.